Okay, the question which I have shared here, I'm solving this question. So we will go stepwise, all right? So very first transaction here is opened a bank account. Okay. Before that, let me tell you that what will be those steps. The very first step number one is that is you have to journalize it. You have to journalize the given transactions. And this is how the journal entries will be made. Once your journal entry is being done, your step number two is that is prepare T accounts. Whatever transactions you have journalized so far, you need to transfer those from journal book to T accounts. And this process of transferring transactions from journal entry to T accounts are called posting. Question might become that what is journalizing or what is posting? We need to know that. So these are the two steps that are involved. Now coming to the step number one, that is journalizing. So given transaction is open a bank account with cash rupees 4,80,000. So how to journalize it? Step number one, analyze that what what accounts are involved in this transaction. So we can see the two accounts that are involved in this transaction. First one is bank and another one is cash. Now, next step will be to find out that what is the nature of these accounts. So both of them asset, cash and bank, both are assets. Now, following the accounting equation, that is A equals to L plus C, assets equal to liabilities plus capital. Accounting equation says that whenever your asset increases, we debit it. And whenever your asset decreases, we credit. This is what we have done in this transaction. We are depositing money from our bank drawer to the cash account. So our bank balance is increasing, means our asset is increasing. So we are debiting it. And similarly, cash is also an asset and it is literally going out of the business. So its value is decreasing. So we are crediting it. So following this rule, we are going to journalize each and every transaction. So in the second transaction, they have said that furniture bought and issued check for 60,000. Means we have bought a furniture and the payment is done in check. Now keep in one thing that when you see a word check, we do not create check account. We create bank account. So two accounts that are involved in this transaction. The first one is bank account and the second one is furniture. Both are again assets. So furniture is coming in and its value is increasing. So we are debiting it and bank balance is reducing. So that's why we are crediting it. Third transaction, bought plant and machinery and advance being paid. All right. So value of that plant and machinery was 1,25,000 and this is an asset for us and its value has increased. That's why we are debiting it. Now the payment is being made. Advance payment is being made 10,000 and which means the remaining amount is still unpaid. So the person from whom this plant and machinery was purchased, he was the company's creditors. So we have to write his name in our books so that we can pay him further in the future. And that is 1,15,000. Fourth transaction, purchase goods from MS Sumit Traders. Now, an item has been purchased, goods has been specifically purchased, and I already told you that whenever we purchase goods, we do not create a separate account like goods account, because this is that item in which the business is being actually dealing with. So we create purchase account and sales account only when we are buying and selling goods, not machinery and furniture and land and building. And this item has been purchased from Sumit Traders and amount is still unpaid. Now, how do we know that that amount is still unpaid? Because they have not mentioned in this transaction that to Sumit Traders, the payment has been made for cash. All right. So purchase account debit to Sumit Traders. Sumit Traders is again our creditors. Next one, this is last one is a bit tricky, but it's easy. Sold goods cost 2,500, sorry, 25,000 to MS Rajni Enterprises for 35,000. Now, what does it mean? That it means that we are selling something. So we can easily know that there is one account which involves sales. Okay. So we are creating sales account. That is sales account, because we are selling goods. All right. And the value of that item is 25,000. But see, we are selling it for 35,000, which means we are selling at a price above 10,000. So we are making a profit of 10,000 bucks. All right. So this is our profit. Now, applying accounting equation, it says that, three accounts that are involved here. That is one sales, Rajni Enterprises, and this 10,000 profit. We have to record these three. We have to record this, make these three accounts in our books. So first one is Rajni Enterprises. He's our debtors. Why are we recording his name? Because the payment has not been made. If the payment had been made, they would have already mentioned in the transaction that paid in cash or paid, but they're only giving us information that it has been sold, not paid. All right. So they are our debtors, and accounting equation says that when your debtors are our assets, increases, we debit it. Sales is our income. Again, accounting equation says that when your income increases, you credit it. And again, when you have a profit and your profit increases, or you are making a profit, so you have to credit it. So putting these values respectively, we have made this transaction successfully. Now coming to step number 2, that is you have to make T accounts. Now, before making T accounts, you have to literally go and find that how many accounts you have to make. Before that, what are T accounts? T accounts are nothing, but these are also called ledgers. Okay. These are like separate accounts has been created so that we can know that how much money has been spent for money, how much money has been spent for buying a goods, or like how much purchase they have done for a specific time period. To know all these things, they create a separate accounts. Okay, that is what is known as T accounts in our books. So the first account that we have to create is bank, then cash, then furniture, then plant and machinery, then MS Ramji, then purchase, then Sumit Traders, then Rajni Enterprises, sales and profit on sales accounts. So many T accounts we have to create. So the very first one, that is bank and cash account. Now you can see bank account debit to cash account. Now, look for what account you're creating. We are creating cash account. All right. And I will write the transaction here. That is bank account debit to cash account. That is 4,80,000 and 4,80,000. All right. So look for what account you're creating here. We are creating cash account. And in this journal entry, your cash account has been credited. All right. So you will write the receipt, the amount or the transaction with which it was credited. That is bank account. I'm repeating once again. First, you look that what ledger you have created. Cash account ledger or the T account has been created. And then look for that transaction, that journal entry basically. This on journal entry, that is bank account to cash account. In this journal entry, cash account has been credited. So you will come to the credit side of cash book and you will write this name, bank account 4,80,000. Similarly, we are creating bank account ledger accounts. All right. And bank account in this journal entry has been debited. So come to the debit side. What account they are having? To cash. You can skip writing to and by. It doesn't make a difference nowadays. So 4,80,000. Similarly, next transaction, furniture to bank. Before that, we will create a furniture ledger account. So we are going to post in our bank account, furniture to bank. Bank account has been credited here. So come to the credit side and then you write furniture account. Whatever the amount is, you will put that amount. And in this journal entry, two accounts are involved. We have already done the posting in bank account. Now we will do the posting in furniture account. So furniture to bank, furniture account has been debited here. So let's come to the debit side. Bank account, and you put the value here. This is how you will go on.